What's up, YouTube family? Back at it again. I'm James, and welcome to my channel where I talk about financial literacy, financial independence, and building your kingdom, right? And this video right now, what I'm going to talk about is what is a line of credit, right? What are the types and what it is, right? And so before I start off, I just want to say, if it's your first time watching this video, just subscribe to my channel, smash that like button, right? And share this video to anyone you think that may benefit from this information. So what is a line of credit? A preset amount of money that a financial institution gives you, which you can borrow from at a cost, right? So that's just like the technical definition, but what it basically is just like just you get a certain amount of funds and you borrow from it at a certain price, and as you put it back, you get to use the funds again. So one of the most obvious ones that we all know, the first one. So I'm gonna get into the types of the lines of credit right now, right? So the first one is a credit card, most obvious one. You use your credit card, put your money back on the credit card, you get to use it again, right? Second one is personal checking or a checking line of credit. And there's different types of categories what falls under the personals, but like the top one is the personal line of credit, right? And the third one is if you're a business owner, if you have a business line of credit. Last one, most obvious, if you're a homeowner and you have, I believe, like I said, it's 10 to 20% or more equity in the home since you've been paying it, since you've been living there, you get to take out what's called a home equity line of credit, where they use your home as collateral to borrow whatever, as many funds as you need to do whatever you need to do, right? What I also tell people is there's a difference between lines and loans, right? So lines I consider good debt, and loans I consider bad debt. One of the main reasons is how the interest is calculated on a line and how the interest is calculated on a loan. So the way the interest is calculated on a line, you'll hear words like daily, periodic, simple, or variable. And it basically means you get charged interest for the amount of money that you use. So you get charged daily interest for the amount of money you borrow. So if you have a $10,000 line of credit and you borrow $5,000, you pay interest on that $5,000 until the point you pay it down. So one month it's $5,000, the next month it's $4,500, so you pay less interest because you're only being charged interest on the $45,000. Month after that it's $4,000, and the interest you get charged on each month actually goes down because you have less and less money being taken out of the line. Now with the loan, you get charged interest for the whole amount of the loan. So if you have a $10,000 line of credit, the whole $10,000 gets charged interest. So if it's a 10-year term, 5%, most likely by the end of that 10-year, you probably would have paid $13,000, maybe $14,000 back to the bank, and that's because of the way the interest is calculated on a loan, basically. And the word is amortized interest, where it's front-loaded on the whole entire loan. So day one, you take out that loan, you start paying interest on every single payment, and it's a fixed interest rate, while the line of credit is variable, right? So it can go up, it can go down, but as you pay it down for the line, you pay less interest on the balance that's left on that line of credit, right? And so what other things separate a line from a loan? So for a line, it's revolving, right? One of the things that separates it from a loan is if you put the money back on your line of credit, you get to use it again. So $10,000, you borrow $300, you put $300 back, you get to use it again. But with a loan for $10,000, you use $300 out of that loan. As you pay down that monthly payment on that loan, you don't get to use that $300 again. That $300 is gone, right? Usually for a line of credit, it's secured, or I'm sorry, it's unsecured. so you don't have to put anything up. But sometimes it can be secured too, so it could be cash for like secured credit cards, or a home equity line of credit where you're putting up your home as collateral, or it could be unsecured where you just have good credit and they see that you're responsible enough with the money and they don't need to ask you for any collateral to entrust you with that line. When with a loan, it's actually the same thing. It's liquid and it's actually unsecured as well. As soon as you get the loan, maybe you may need a cosign, but most likely you don't need to put any collateral, any cash or any home or a car or something like that to get the loan, right? The other thing that separates loans and lines is how when you actually do pay down that line of credit, you're actually building your credit, right? To the point where they see like, oh, this person is good with paying their bills on time, and because it's a line of credit, you actually get not rewarded. Well, yeah, you get rewarded for paying your bill on time. With a loan, like, yeah, you're paying your bill on time with the loan, but you're not getting actual rewards because of all the interest that you're paying on that loan, right? When we think about reasons for wanting a line of credit, people say, why would I go to a bank or an institution and ask them for that line of credit? What I would tell them is 4 reasons. What you would want is to eliminate expenses, right? You want it to pay off any debt that you have. And when you pay off the debts, that increases your cash flow because you're not putting that money towards any debts anymore, right? And then you want to build your credit, right? That's the most important reason. When you build your credit, you show them that, listen, I'm responsible, I'm good with money, I can handle money, and you get more and more credit and more money. And in the future, we get to use that to pay off debts. And when we are debt free, we get to use that to buy assets to build our kingdom, right? And so that's just a quick just definition on what a line is and the difference it is between from a loan and the 4 types of lines. So quick recap, the 4 types are credit cards, personal or checking lines of credits, business lines of credits, or home equity lines of credits, right? And what separates it, what differentiates it from a loan is it's revolving. It can be unsecured or secured. It's liquid, if you need the money, you get to use it whenever you need it, right? And how the interest, the main part is how the interest is calculated, because loans are liquid as well. They're unsecured as well, but they're not revolving and the interest is calculated completely different, right? They're not revolving because as you pay down that loan, you can't borrow that money again. And the way the interest is calculated is you're paying interest on the whole entire loan for the whole loan's life, as long as you make those minimum payments. So every single minimum payment you make, that bank is making money off of you, or that financial institution is making money off of you, right? That's just the main difference between a line and a loan. So like I said, I consider loans bad debt and I consider lines good debt, but once you figure out velocity banking and you get into how to use the good debt to pay off the bad debt, loans can actually be considered good debt as well once you get into how fast you can pay off that loan. If you only have a line that goes up to a certain amount of money and you're a business owner or something happened at your home or emergency and you need a loan, you know that you try to get the longest term, the longest repayment time that you can on it, but eventually that you'll be able to pay that down in the fastest way possible. And that's the whole point. Speed, saving money, building credit. That's velocity banking, right? And being stress-free. Then we get into financial independency. Then we get into building our kingdom. So, and I hope you like this video. Hope you learned something, and I'll catch you next time, all right? Take care.